Right, so joining me on the desk now is Peter Major from KD's Corporate Solutions. We've seen strong outflows out of the bond market since the beginning of the year. About 22 billion rand coming out of the market, and of course selling by foreigners. We've also seen a bit of a sell-off coming to the fore when it comes to the equity markets. And as I mentioned, Peter Major is here with me now to discuss this further. Peter, thank you so much for joining us once again. Massive outflows from the bond market and equity market. According to Rob Tal, we saw an outflow of around 2.5 billion rand last week on the equity front, and since the beginning of the year the bond market has experienced 22 billion rand outflow. These are very big numbers. Are you concerned?
Well, I think everybody should be concerned, because we know when we have big bond outflows, let alone equity outflows, it's going to affect the currency. And we had unprecedented bond inflows, especially the first 3 quarters of last year. I think we had, what, 70, 80 billion rands of bonds. I think it was an all-time foreign inflow in South Africa in its history. Yeah. So it took our currency from 750, 730, 710 all the way down to 660. But like all good things in life, it comes to an end. It's cyclical.
So you're saying it's going to come to an end?
Well,
I
think
it's start seeing selling.
Yeah, we saw selling in the last quarter of last year, and this has just continued. But I think we sold 28 billion rand of bonds in the last quarter of last year, and you're talking 22 billion have been sold this month. So this is the kind of action that can push the currency to 750, 730.
What do you think the catalyst was for this sell-off? Do you think it was because the Reserve Bank says that it is going to try and weaken the currency? Do you think it's because we perhaps seeing the end of the interest rate cutting cycle here in South Africa? What do you think prompted this?
Yeah, I think those were the big factors. I think nobody could really have expected more interest rate cuts here, but there were people who did, and they kept that idea floating in the paper and the press. And we got pretty solid confirmation from the Reserve Bank. There's no more interest rate cuts, and they're just going to let the currency do what it needs to. And I think maybe that was a trigger, maybe not, but there's a lot of worldwide factors. We see interest rates are going up overseas. We see inflation is going up overseas. It's much higher in China, in the UK, and Europe than people had led us to believe. And that means it's only a matter of time before interest rates go up in those countries. And so we know we can't go lower, so we will follow. Might be a little late, but we'll follow.
So where are investors taking their money to? I mean, are we seeing more buying coming through in the developed markets finally, given the fact that they've lagged? I mean, it seems that most investors last year were looking for yield and not really growth, and perhaps now we're starting to see a change in perceptions.
Yeah, I think we're going to develop markets, particularly on the equity side. And the better fund managers and analysts have been recommending that for the last 6 to 9 months. They say these emerging markets are turning into a hothouse. You just look at the graphs, you look at the performances. South Africa was at a 30-year high to the United States. I think we were at a 35-year high, and this is in dollar terms to Europe. So that Euro 350, you wonder how could it get pounded down anymore, but you also wondered how can these emerging markets get pounded up anymore. And the swift turnaround. I think the Euro 350 is up 16% this year, and we're down 2 or 3.
Well, it's interesting, Peter. I mean, one of the reasons that we saw such strong flows in the equity market and bond market is because there was excess liquidity, because of quantitative easing and you know, the printing of money, if we could call it that, in the developed world. Do you think that is starting to dry up?
I think it is slowing down. And in a currents like that, because the markets were so stretched, the bond markets and the equity markets, they were so stretched, you needed increased printing of money to even keep them there. If you just left the printing where it was, they were going to start coming down. And heaven forbid you start decreasing the printing a little bit. When something is so stretched, it needs even more and more power to keep it. And if anything, with these growing world economies, with inflation, I think the printing money is going to decrease
So
quick.
in other words, you think inflation is definitely going to be a very big issue going forward? I mean, we're looking at what's happening on the food front for many emerging markets economies, and some economies are still not experiencing it, such as South Africa.
Look, to say it's a big issue, I don't know if inflation is going to be out of control, but let's just take America. I think long-term inflation for 100 years has been around 4%. So maybe the last 2 years it's been about half or 1. That's abnormal.
But they don't include food and petrol in their CPI baskets.
Well, the fact is things are reverting to the mean. If inflation just goes back to the mean, if it just goes back to 4% in the United States, and what's our long-term inflation rate here? It's probably 8, 9, or 10. Gee, if we just go to 6 or 7, all of a sudden our bonds look a little too cheap, a little too expensive. And that's what I think. For now, I don't see inflation out of control, but I see it getting back to a long-term average, and that enough will change